Hello everybody, I'm Hugh Johnson and I look forward to checking in with you once again, talking to you about what we see ahead for the financial markets, what we see ahead for the economy in 2020 after what can only be described as a really spectacular 2019 with the market up about 30%. It ranks as one of the very, very best years in financial market history. I've gone back through the numbers to 1890. And this has beaten, the 2019 was stronger than 83% of the year periods, 1 year periods that we've had since 1890. So it was a really good year. And I've also, of course, looked at what happens after you have such big years. And just as everybody suspects, you have good years sometimes, but on balance, they're nowhere near as good as what we saw during the big up year or during the 30% plus year that we had in 2019. Single digit on the upside, but certainly not anywhere near what we saw in 2019. Those kinds of years only come along periodically or occasionally. When we look ahead towards 2020, things look a little bit more benign, a lot more benign than they were in 2019. The economy looks like it's going to slow. I think we all kind of know that or suspect that. We were 2.3% growth in 2019. It'll look like it's going to be about 1.8 or 1.9% in 2020. Inflation's going to be pretty benign, somewhere around 2%, maybe a little bit higher than 2%, but not much. Under those conditions, with the economy slowing, with inflation picking up just a little bit, the Federal Reserve is likely to leave interest rates unchanged. You can't tell for sure. Very tough to forecast Federal Reserve policy, but I would look for Federal Reserve policy to be essentially unchanged or a little changed as we move through 2020. Under those conditions, interest rates fairly stable. Longer-term interest rates maybe up just a little bit. And the stock market, again, when you kind of put all the numbers together, it might be an okay year, but it's certainly not going to be a great year. That's assuming that we don't have what's now popularly becoming called a melt-up, or a move from something that's more rational, an investment stage, which is what we had in 2019, 2018, and 19. Something rational to something a little less than rational, where we see a surge in exuberance or optimism, which has been missing from this market. So we're looking for a pretty benign, certainly comparatively benign 2020 compared to, again, 2019. There's a lot to think about. There's a lot to worry about. There's the coronavirus, which, of course, we're all thinking about, focused on right now, very concerned about, and the impact that might have on the Chinese economy, an important export destination for the U.S., the global economy, and the U.S. economy. We don't think, based on history, the history of these kinds of crises, that it's going to have that big an impact on the global and the U.S. economy, but we have to watch very carefully to see if it will. It's a big year as far as, we've got the impeachment going on, and of course it's an election year. And keep in mind that the election years tend to be pretty good for the markets. It's the post-election year that's not, generally speaking, historically, that good for the markets. So I think as we start 2020, especially as we see the market's performance in the early going in January, it looks like going to be a positive 2020, a positive for the economy, a positive for inflation and interest rates, and maybe modestly positive for the stock market, assuming we don't get into something that might be called a melt-up or a more speculative financial market environment. So we're watching very carefully. You know my big concern, and my big concern is this has been the longest bull market in history, the longest economic recovery in history, so we've got to be paying really close attention, and just in case we see those signs from the financial markets or signs from the economic numbers that tell us that we're at the end of the cycle and that we're going to start a bear market and we'll have to take steps to reduce our allocation to equities. Try to continue to do our best. We got more people working really hard at it. And above all, I really appreciate your confidence and very much look forward to you giving us a call, talking to us, telling us about your concerns, telling us about your worries, talking to us about your portfolio. The confidence you've shown in us has been great. We've had a higher than benchmark allocation to equities. We continue to do so, but believe me, we're watching really carefully because, again, this has been a very long bull market. Again, give us a call. Very much appreciate the confidence you've shown. Thank you.